Good morning. The next topic is changes in accounting estimates. Due to uncertainties, many items in financial statements cannot be measured precisely but can only be estimated. Such estimations involves judgments. Such estimates are based on the judgments. These judgments are based on available information. For example, estimates may be required for provision for doubtful debts on sundry debtors, provision for inventory obsolescence, estimation of the useful life of fixed assets, etc. All these are based on estimates. When changes occur as a result of new information or experience, an estimation may need a revision. Similarly, accounting estimates may change when circumstances change. Thus, a change in estimate does not require restating the financial statements of a prior period. For example, Eagle Airways has an airline fleet. New legislation will ban them for use on international flights. This will reduce their useful lives. Hence, this will need to accelerate depreciation and review their residual values. State whether this is a change in accounting policy or change in estimate as per Indian Accounting Standard 8. This is not a change in accounting policy. This is a revision of estimate and will have no impact on prior periods. The depreciation in the current and future periods will increase. Change in measurement basis. A business may require a change to be made in the measurement basis applied. This should be considered as a change in an accounting policy and not a change in accounting estimate. A change in measurement base is considered as a change in accounting policy and not a change in accounting estimate. For example, Arun Limited's investment property has been accounted for at cost. Investment property accounted at cost. Now it revalues its property. State whether this is a change in accounting policy or estimate as per Indian Accounting Standard 8. This is not a change in an estimate. This is a change in measurement basis. Hence, this is a change in policy. Errors. Errors discovered during a current period may have arisen on account of mathematical mistakes, incorrect application of accounting policies, misinterpretation of facts, oversights, or frauds. Accounting treatment of errors. An entity should correct all prior period errors retrospectively in the first set of financial statements approved for issue after their discovery. This correction should be done by first one, restating the comparative amounts for the prior periods presented in which the error occurred, or if the error occurred before the earliest prior period presented, restating the opening balance of assets, liabilities, and equity for the earliest prior period presented. For example, Krishna Limited owns a building that is used for the purpose of own business and for administrative purposes. The building was carried in the financial statements at historical cost. In a subsequent period, Krishna Limited decided to adopt the revaluation model to determine the carrying amount of the building. So, earlier, Krishna Limited used historical cost method for showing a building, and in the subsequent period decided to adopt a new method, revaluation method, to determine the carrying amount of building. whether this change from cost model to revaluation model shall be treated as a change in accounting policy as in Indian Accounting Standard 8. A change in accounting policy is to be dealt with as a revaluation in accordance with Indian Accounting Standard 16 or Indian Accounting Standard 38 rather than in accordance with Indian Accounting Standard 8. Hence, this change in the accounting for the building from the cost model to the revaluation model shall not be treated as a change in accounting policy in accordance with Indian Accounting Standard 8. Interim reporting. International Accounting Standard 34 and Indian Accounting Standard 34. Companies generally publish interim financial reports, usually at the end of 6 months. Interim financial reporting improves the ability of investors, creditors, and others to understand an entity's capacity to generate earnings and cash flows and its financial conditions and liquidity. The objective. The objective of this standard is to prescribe the minimum content of an interim financial report and the recognition and measurement principles for an interim financial report. Interim financial reports. Interim financial report means a financial report containing either a complete set of financial statements or a set of condensed financial statements for an interim period. Then what is an interim period? Interim period is a financial reporting period shorter than a full financial year. What are the minimum components to be included in an interim financial report? An undertaking may publish a complete set of financial statements in its interim financial reports rather than condensed statement and selected explanatory notes. An undertaking may provide less information at interim dates as compared with its annual statements. An interim financial report should include, at a minimum, the following components. First one, a condensed balance sheet. Second one, a condensed statement of profit and loss. Third one, a condensed statement of changes in equity. Fourth one, a condensed statement of cash flows. And the last one, selected explanatory notes. Okay, thank you.